So over the course of the next hour or so, my goal is to show you how you can use the volatility box to trade like a smart probabilistic trader. But first, we need to go with the educational disclaimer. So again, you've all probably heard this many, many times. But anything that we share today is solely for educational purposes. It's just my opinion. A lot of you know just from listening to my videos, I have a very specific trading style. That by no means is a recommendation to buy or sell any of your securities or specific trades. But I do hope you're able to get something out of this presentation and adapt it to your own trading style at the very least. So throughout this presentation, we'll start by first addressing some of the common problems that we as traders face. And I say we because I'm guilty of this myself. It happens on a day-to-day basis. Nobody's perfect. But I'd like to talk about what some of these problems are, which then leads me into why I created the volatility box, why our team continues to build it, continues to improve upon it, and really the value that we get from it to help us trade futures like pros, or at least professionals, in the sense of winning more often than losing and having our equity curve go up. Another thing that I'll also show you, and this is something that I'm really excited to show, it's the first time that anyone, and I mean absolutely anyone, will see this tool, which is how you can use the volatility box to trade stocks. And this is in beta. We actually finished this just over the weekend, or at least the first version. And so I'm hoping this will be an interactive session where maybe if you have some stock picks that you're looking for throughout the day, we can actually plug those into how the volatility box would help you trade each of those stocks. Then we'll have some time for Q&A. And I doubt we'll have time, just given the way I think most of these presentations are going. But in case you'd like to download any of our free indicators, play with them, so on and so forth, it's available on our website, tosindicators.com/indicators. All right, so that's sort of just a preview of what you can expect. Now let's get started with the presentation. But before we do, I just want to make sure that you're all aware. My goal is to make this interactive. So if you have questions along the way, just type them up. I have the chat screen open on a separate monitor, so I'm hoping to answer all the questions as they come. But if I'm in the middle of a slide, I'll get to it. But my goal is to answer all the questions, and we'll have plenty of time to do that. Okay, so when I was starting to learn how to trade, one of my mentors who taught me about trading psychology always used to say this, right? And it used to piss me off at the time, but it's true. Trading is easy. It's not simple, but it's easy. And at the end of the day, you could have an immensely successful trading strategy in which you look at, say, several moving average crossovers combined with, say, a MACD or an RSI, and that's easy, right? Because at its essence, all that really is a bunch of lines that cross, that generate signals that tell you when to trade. That part is easy. It's taken care of, and there's 100, if not thousands, of systems out there that can help you trade. But now the trick is, can you continue to take those trades even when you have, say, 5 losers in a row? Probably not. How about 10? Well, that becomes increasingly more difficult, right? And now to play the converse side, let's say that you've been on a streak of 5 winners in a row. Do you still continue to trade in the same way, using the same size, using the same consistent, repetitive approach on those trades in subsequent future trades? Or do you start to think to yourself, this works? And you obviously increase your size before it's appropriate, maybe just factoring in greed, so on and so forth, only to face a setback, and then your equity curve goes straight back down, right? And so this is where the idea of trading being not simple comes in, but it is easy. It's easy if you follow the rules. And so I've tried to identify some of the common trading problems that I faced myself, not only this year, but also just when I was starting to learn how to trade. And I think this is pretty common for most traders that I've spoken to. And the first one, and this is key, is we overcomplicate everything, right? What I've noticed about the evolution of a trader is when you first learn how to trade, you maybe have your 1 or 2 indicators on your charts, and you start to taste some of the success. Then, as time goes on, you add more and more to your charts to quote unquote get more information, right? You think that this more information will help you, say, prevent a loser, maybe help you get an additional winner, whatever it may be, but you start to add more to your charts. And at one point, and this point comes way sooner than I think any of us realize, is you have way too much information. You have conflicting signals. Things like the moving averages might be telling you to go long, while say the VWAP is telling you to go short. The RSI might be showing overbought, while say if your favorite stochastic showing oversold, right? Conflicting signals all over the place. And now enter most traders' dilemma, which is analysis paralysis. You're frozen there, like a deer in the headlights, just confused, right? And why wouldn't you be? Your brain cannot handle the number of inputs that you've now given it to make a smart decision and to make that decision the same way every single time over, if that's how your trading style and approach is, right? Which then leads you to the next problem, which is the lack of a systematic, repetitive approach. We had one trader, and I'll give you an example, right? So we had one trader who's still part of our community, and I've talked to him about this many times, so I'm happy to share this story. But he had discovered, or he really liked the idea of an 8 by 34 EMA moving average crossover. And all of the backtests showed this to be an immensely successful strategy. I'm talking, I think, when he ran it on the S&P futures chart, I think on a 3-minute time frame, we saw that the P&L was, I think, a positive 25K, trading just a one lot. And that was insane. It blew his mind. And to anyone, it would blow your mind, right? You're almost thinking that you struck gold. How is it possible that two lines, when they cross over, with some other rules, of course, can give you this much money? Well, what's the catch? The catch to me is that the losing percentage was greater than your winning percentage. In fact, with this 8 by 34 crossover, I think your winning percentage was a little bit more than 30%, very similar to the turtle trader strategy for those of you who are familiar with that. But really, the winning percentage was 30, right? So now you have to ask yourself, well, can I continue to take the trades knowing that I win only 3 out of 10 times, let's just say, and 7 out of 10 times are losers? And those 7 might be consecutive. The answer is usually no. But the back test assumes that the trader would trade in the same fashion. You trade the same way over and over, in a repetitive, systematic way, that actually helps you get to this 25K that the back test is showing you, right? But here's the actual trick that most people don't really think about. And that's this little thing called emotions. Let me actually make sure that this is hidden just in case you guys see that. But it's something called emotions, right? That gets in the way and it disrupts the repetitive nature of our approach. If you have 7 losers in a row, it is so hard, and maybe you have the skill, but I for sure don't, in that I can continue to take the 8th trade with the same degree of confidence, with the same degree of probabilities, and trade it in the same exact manner to try and replicate these results. It doesn't happen, right? My emotions get the better of me. I try to be a little bit too cute, and that always never pans out, and that's essentially the doom of, I think, most traders. The next point is I think a lot of traders trade a little too often, right? And the reason that I think that happens is because without any sort of real edge, you just start picking random places, right? And you don't take the same approach. You're using the same indicators, but you might say have a trade that works one time. You'll try it a second time. It doesn't work. You switch to a different strategy. You try trading that, trying to say maybe a revenge trade, maybe make back what you've lost, so on and so forth. And I think we as humans, and especially traders, we hate to lose much more than we win. And I've just noticed this to be a fact, right? I think most traders, or even just humans, you've grown up with this competitive killer spirit inside of you. If you played sports, this is ingrained, right? I used to be a basketball person growing up, and that it was one of those things where you just hate to lose. You hate when someone else wins, but losing is the feeling that sucks a little bit more. I think that translates into trading a little bit. Another big one is the lack of a written trade plan, right? And I think everyone, anyone who's ever tried to advise on trading or maybe give you some tips would say this. But I think most people don't address why a trade plan is so important. It's not only just your map, but what I think it forces you to do is translate your observations, your trade ideas, maybe price actions that you've noticed into a tangible rule set that you can apply over and over and over again, almost in a programmatic way and kind of like a checklist, right? Most people lack this. And this is something that I used to lack myself, right? My trade plan was in my head. I knew exactly what I was looking for. But of course, there comes that one time where I deviate from my trade plan thinking that it'll work. It doesn't work. And of course, there's nothing that I have to fall back on. So I find that to be a pretty big whoa. Now, here are the two biggest killers of market killers of 2019, in my opinion. Right, and the first one, it just both of these are frustrating. You can't avoid them, but it's just the truth of the matter of the current landscape, which is your inability to adapt to changing market conditions, especially with say events like today where we had the PMI report come out. How do you adapt to the changing volatility today, right? How did Paul make good money on the Russell today? Well, that's because he was able to adapt to whatever the volatility is that we were seeing today. And second is, and we're all familiar with this now, it's when a simple tweet or a news event completely disrupts your trade. It throws you off. A trade that you might have, say, taken hours, if not days to build, is killed by 140 characters by someone who has no idea who you are, has no idea of your account size, but you've lost your real hard-earned dollars on that trade. Right? And all of these, while they're not very nice, they are hard truths and the harsh realities of the current landscape of the market conditions that we trade in. And it's our goal as traders to find a way to trade inside of that and consistently continue to take out profits and add them to our account, your wealth, whatever it is that you trade for, right? If it's your retirement, your 401k, your IRA, whatever it is, but it's our goal to take out profits. We don't do this to lose money. And so that is exactly the reason why we created the volatility box. The volatility box is an incredibly robust trading indicator. It's currently available only for Thinkorswim, but we update this weekly. And every week, we analyze more than 16,000 data points using custom built statistical models and formulas to give us volatility ranges. And these volatility ranges are what we can then use to trade, say, the four indices, so the S&P, the NASDAQ, the Dow, crude oil, the four indices, along with gold, crude, and the 30-year bonds. And also for those of you who trade micros or maybe prefer trading options, the ETF options along with the micros are also supported. And I think, Paul, you're a little curious to hear about this as well, so I'll just take a quick caveat to touch on this. While we analyze 16,000 data points every week, to build these models, we've analyzed, I believe now we're upwards of 6.5 million overall data points. So you know that when I give you these volatility ranges every Sunday, there's a lot of analysis, there's a lot of thought behind it, and there's just a lot of data that we've looked at to come to these final volatility ranges that let us trade the market in a consistent condition. Hey, Trend, nice to see you. I see your comment. But anyways, so with the volatility box, it gives you information. So by 7 a.m., for example, I'll give you an example. By 7 a.m., not only me, but all of our subscribers and anyone who has our trade plan can tell you exactly what type of volatility to expect in the markets for the rest of the day. So that's powerful information at your fingertips less than 30 minutes after the market opens. Also, you can identify likely trending market conditions, right? Or trending markets, I should say, by 7 a.m. And that's what we were able to do today. Not quite by 7 a.m., but we used the same rule sets and we knew trending markets early on in the day as a result of the PMI numbers. And I'll show you examples of all of these. But first, I'd like to just give you some context so you know just the power of the volatility box models. Now, after 7 a.m., we use the volatility box to start to fade price action at the edge. And our common phrase, our popular phrase that we're known for, is trading at the edge with an edge, right? And after hours is also included. But really, the volatility ranges are meant to do that. They're meant to help you fade price action in a way where statistics is on your side, probabilities on your side, and you almost have X-ray vision where you can see these levels that I think most people just don't see. And for most people, this type of data, it's not easily available, right? This type of data is usually, it's expensive. These models aren't accessible. We've spent a lot of time building these models, and they're typically reserved for the larger institutions, hedge funds, so on and so forth, who can afford not only the models, but the folks to come in and analyze the sort of data and give you some sort of actionable insight from it. We also now, for example, the volatility box helps us make tweets our new best friends, right? Whenever our president tweets, that to me is an awesome opportunity to try and capture this volatility move that we're going to have, because more often than not, that move reverses and it's just the initial reaction that we're looking to fade. In fact, we thrive from tweets, which is kind of a crazy thing to say, given how I think most of the market has fared when the president tweets. You can also know things like what type of volatility to expect ahead of key events, right? So think crude oil reports. Well, we know what type of volatility to expect in a crude oil report by, I believe, 6 or 7 a.m. Pacific, based on how the market's traded. And so by the time the report comes out, we're ready to go, levels plotted, ready to trade these reactions. And of course, we can also use the volatility box to trade things like FOMC events, unemployment reports, anything of that sort with confidence and ease, even things like the PMI today. Right? And so this is all just to illustrate the power of what one simple tool can do. And if you tie back to the common problems that we talked about, there's one tool. You don't have analysis paralysis. You don't have conflicting signals. You're sticking with one approach. We give you a trade plan that works, and you're able to train your mind to look at the market in a way that you haven't seen it before, and really just start to profit and start to trade with confidence. You may not win every single time, but you will be trading with confidence, and you will be trading as a probabilistic trader where you're just repeating the same approach every single time, right? And so before I show you any examples of these charts, let me first show you how you read this indicator. So, well, this is straight from our trade plan right here on the left. And I'll pull up my pen just so we can make this a little interactive. So this is what our typical chart looks like. And what you see with these clouds and these lines, that's the volatility box. So we have a very clear entry line. It doesn't matter what the conditions are. The cyan dashed line is our entry line, no matter what. Our stops are always, and I mean always, outside of the volatility box, where we give it X number of points of room, and we have made this programmatic, which I'll show you in a second. But our stop is always outside of the clouds, right? So we've given it this much room in every trade. Now, our first target, and we always trade at least in increments of 2. You could trade just a one lot if that's what you prefer, and where you take it off at the first target. But our goal in all of our reports is to trade at least a 2 lot. And our first target on that 2 lot is exactly what we risked. So our risk to reward for our first target is always, and I mean always, 1-to-1, which already skews the probabilities in your favor, right? If you have an approach into the volatility box, for example, I think our winning percentage is close to 72%. So now if you're winning 72% of the time, and every time you win, you're winning at least making at least what you lose, you come out on top. Our T2 now is our stretch target. So after we hit our first target, we move our stop to a break even. So now we're playing with house money. It's really just free. It's a no stress trade. And so just to take you through a real example here, we hit our first target. Our stop was Apollo. You need to click TOS indicators in the chart to see our video. Um, Anyway, so once you hit our first target, we've now moved our stop from outside of these clouds back up to break even, or maybe just one tick ahead of break even to cover commissions, right? That's up to your personal trading style. Now, the second target is plotted on the opposite side of wherever you took your entry. Again, these levels are pre-plotted, ready to go. None of this is a lagging indicator or anything of that sort. This is all real time. And this dash line is also calculated using statistical models where that gives us our target 2. It's a place where price gets to more often than not and then starts to reverse, which is what you see right here. We hit our T2, we hit it multiple times, and then price started to reverse, right? And that, in a nutshell, is exactly how you use the volatility box. It's incredibly easy, and we've designed it in a way that your brain can just start to look at this, and you should almost, as bad as it sounds to say, get bored trading because it's so repetitive and it's so easy and it's so systematic. It's a process-driven approach, right? And that's what our goal is. Now, if you're looking to short, the lines are exactly the opposite, right? So if you're looking for a short entry, for example, your entry is at the same cyan dash lines. Your stop is outside of the volatility box. Paul, beautiful. Methodical is exactly the word that I like to use. In fact, it's a word I use later on. You stole it right out of my mouth, so thank you. But our entry line is where we enter. Stops are outside of the volatility box. Once again, your first target would be exactly what you risked. And so you've made sure to have a 1-to-1 risk to reward ratio. And your second target is the opposite side's target line, which is the gray dashed line. And really, all of this to say you have a process-driven trading approach. We have clear trade setups and rules that are defined in a trade plan that we provide to all of our members. And this is all written. But if you take a look at it and understand this trade plan, we even list out things like how you trade a crude oil report. How do you trade FOMC events? How do you recognize if volatility is going to happen? How do you glean information from the volatility box models, even if there's no trade that sets up? And these are all well-defined patterns and observations that we make available not only in our trade plan, but also in those nightly videos that I showed you on our YouTube channel, right? Because at this point, you're playing probabilities. You're not shooting blind darts. You're not hoping that something sticks, but you're trading probabilities, right? And so if it doesn't work, that's fine. It's probabilities. It's just another trade. Danny had actually sent us a video, which I sent to our subscribers by a trader by the name of Rambo. And thank you, Danny, for sharing this. But in it, he says something that I think is just so brilliant. He doesn't look at a trade after he sets it. It's just another trade. And so for us, we have our orders placed. Once we hit our targets, we just adjust our stops, and whether we hit this target or we get stopped out, that doesn't matter to me. I'm trading the same approach, the same levels every single time. Um, Steven, you ask, I'll answer your question in just a second, Steven. Let me just get through this slide. Um, Another thing that I think is really cool about the volatility box, and especially our models compared to, say, any of our competitors, is that we give you both a conservative and an aggressive model. So you have two different sets of indicators. The aggressive model is for days not like today, for example, where we just have relatively muted price activity, but we do have moments where we start to sell off, maybe on no news or on some very trivial news. And the aggressive models there are beautiful to help us try and try and fade those edges. Now, in days like today, where we say have the PMI numbers where we're sub 50, and that's a very clear sign of, say, the economy starting to stagnate, that's a little bit more serious, right? And that's something where you can then start to use the conservative models because that requires you to be a little bit more cautious, manage your risk a little bit better, and trade whatever the setup is using a conservative approach. But either way, both models you can identify by 7 a.m. which one you should use, and they allow you to adapt to the market conditions for that day. And I'll show you examples of all of this. And finally, one more thing, and this is a new feature that we added as of this past Sunday, actually, is we even have clear entry targets and stops. So none of this, none, absolutely no part is subjective, right? So if I just show you a quick example of a chart right here, at the top, we have our entries, our targets, our stops, already plotted for each hour, right? So for example, in this case, if you're looking for a long entry, your entry for the S&P would be at 28.25. Your stop is outside of the volatility box plus some risk already defined, so 20.75. And we have both our first target, which is exactly what we risked, and our second targets plotted ready to go. So it doesn't matter if you're trading on Thinkorswim, because I know a lot of you like to use, say, Infinity or AMP futures, anything of that sort. You have these levels so that you can manage your trades on whatever platform and really just use TOS as a charting platform. And that to me is really just why the volatility box is so damn awesome. I like to use it. It's changed, and I want to say revolutionized, but I don't want to oversell it. My entire trading approach. You become process driven, you become disciplined. As Paul said, you become methodical. I think that's the power of it. Stephen asks, how do you reconcile this method with opening range breakout methods? Great question. So to me, you can use this as information. So if you have a favorite breakout method, I know a lot of people say, our subscribers, they've told us they like to see which way price breaks in the first 30 minutes, and that to you indicates your bias. That's fine. You can start to use the volatility box to give you price ranges as a means to participate in whichever way you're breaking out. I'll show you. We have a different method of identifying what a real breakout is using statistics and models. But if you're using, say, other indicators, this just becomes another form of information. I think what I've found most of our traders to do is just more and more you start to use the volatility box, the less you start to use other indicators or just things that I think lose more often than win or are a little bit more frustrating or they're just not as objective, right? If those systems are objective and you can tell me on a binary scale that, yes, you know what, no matter what, every single time this happens, it's either a 1 or a 0. Either it's true or it's false. Then you can start to trade those systems and use, say, if you had an entry to go long, the volatility box gives you an area where you should place your stop outside of to avoid getting unnecessarily stopped out. If we say happen to fall in the direction, if you're looking for a pullback, these start to give you areas of pullbacks where you can now participate in the direction that your other breakout indicators might have given you a bias towards. There's just a lot that you could do with this. TrendWiz, to enable the audio, you click the audio and make sure that I'm not muted. Just click the green dot, or if you have a red dot, just make sure it's green. All right, any other questions before I actually show you some example charts, and then we'll just go straight live? No? All right, I'm going to just take a quick breather to drink some of my tea. All right, perfect. So now let's get into charts because I think a picture tells 1,000 words, and it'll show you the system a little bit better in all sorts of approaches. What room am I showing my charts in? The workshop room. All right, so let's move on. So now let's look at example charts, and we'll start off with, I think, how we start every single one of our videos, our nightly videos, in which we talk about which volatility box we should use. So here, for example, we have a chart of the Russell. Greenie, are you in? I just want to make sure that you're in before I start. So you want to click the workshop room. So in the bottom right in charts, you'll see in workshops, TOS indicators, volatility box, and then the audio, just make sure you have myself, Kaushal, the audio enabled or TOS indicators. John might be able to help you out with that. But in the interest of time, I'm going to keep moving forward. All right, beautiful. Oh, broadcast. Okay, well, either way, I'm glad you're in. All right, so now let's take a look at the Russell chart here, right? So this is a Russell chart, 5-minute chart. Doesn't matter what time frame you use, 5, 15, 30. As long as it's under an hour, you'll see the same exact thing. So that's really just a personal preference. So to us, in this chart, most people will see this as just, okay, we're chopping a lot. To me, this tells me very clear information. So I see that the Russell has broken past the aggressive volatility box clouds. And you see that we're on the aggressive clouds using this label in the top left-hand corner. And we see that we've broken past these clouds. And so to me, that already signals, and this is by 7 a.m. Pacific, so 30 minutes after the market opens, that we should expect greater than usual volatility for the rest of the day. Right. So now what do? For most people, okay, you're either shit out of luck, you're trading the aggressive model, or you're just sitting out. For us, we have two models, and that's where this becomes incredibly powerful, right? So that's my sign, and this is a chart of September 12th, if you'd like to follow along. But this is my sign to switch on over to the conservative volatility box. And as soon as I switch on over to the conservative volatility box, this is the same exact chart. Yes, Mike, only Thinkorswim for right now. Although we are working on introducing it to a few other platforms, right now it's just Thinkorswim. But now back to the charts. So same exact chart. Now we have our conservative volatility box model plotted. And we see that this contains price action far better, right? Price is staying inside, contained inside of these volatility box clouds. And so for us, that then is our sign, gives us the edge to now adapt to these models and start to trade using our conservative model. So our first entry, if you remember the chart where we taught you how to read the indicator, is when price slammed into our cyan volatility box entry lines. So as price moves up, we get our entry to short. Our stop is outside of the volatility box where we've given it 4.5 points of room. And again, these levels are plotted as of 7 a.m., right? And so they use the low and the high of each hour. So here we have the low. And so we have this volatility box plotted ahead of time. You have 5, 10, 15 minutes to get your orders ready to go, parked with your stops, your targets, everything. And so we have our stop outside of the volatility box, 4.5 points. Our first target, once again, the 4.5 points, right? And so as soon as we hit our first target, that then gives us the opportunity to peel off our first contract. We move our stop to break even, and our second contract has a target of the target line, which represents 11 points in this case on the Russell. Our stop is now basically we're protecting break even plus a few ticks for commission. And so this is a free trade. You're playing with house money. Both of these targets get hit, and that gives you a total of $775 trading a 2-lot in less than an hour using an approach that you can repeat time and time and time again where you have probabilities in your favor. Any question on the Russell chart before I move forward? No? All right. And Mike, I think I answered your question, but yes, Thinkorswim only for right now. We are working on introducing this to more platforms. Okay, next, let's take a look at the S&P chart. And now we'll look at a news event, and this is from last week. Yes, this is a proprietary setup. Ron, it's only available for Thinkorswim, but we are working to try and introduce it to NinjaTrader. Don't bank on that. We're just going to say Thinkorswim for right now. Now let's look at a news setup. And so last week, we're not trying to pick and choose. We had news on the 27th of September come out where we essentially this hit the market that the White House was weighing, again, keyword being weighing, limits on U.S. portfolio flows into China. Now, when this event came out, the market plummeted. This was, I think, like an 18 or 20 point candle. So about $1,000 if you're trading the full size. And that's scary, right? Most people are scared. This to them represents a sell off. Our subscribers are ready. We're waiting. We're eagerly waiting for the sell-off to come because as soon as this news hits, we're switching to our conservative volatility box because it's a news event, and we're waiting to try and have an opportunity to buy this dip, right? Give us our best sense of entry where we can buy this dip and see if we can fade the edges. And that's exactly what happened here. As we sold off, everyone is fearful. We had the ability to go long. We had our orders parked at the entry line. Our stop was outside of the volatility box, where we gave it 8 points of room on the S&P. First target, once again, this should be repetitive now. 8 points, target risk reward of 1-to-1. And our second target is at the target line, which is at the volatility box target line, which represented 14.5 points. Right, so both T1 and T2 are hit. We had the reaction where we hit both of our targets, I believe, in less than 25 minutes. So that was a really nice trade, helping us make 1125 on a 2-lot. Again, same exact approach. We just have the tools and the ability to adapt to whatever conditions the market throws at us, right? A news event hits, no problem. We'll trade it using our conservative volatility box models. If there's no news event, then we can continue to use our aggressive volatility box and fade any edges that come. So I'll pause here again. Any questions around this news event trade? And we have, I think, 6 total examples, so we'll have plenty of time. Don't worry, far more examples where if this doesn't make sense yet, it'll make sense. Would I have sold the upper volatility box for a short? Joe asked. That's a beautiful question, and one of our most popular questions. So we'll take a step back. The way the volatility box plots is using the low and the high of each hour. So now this right here represents the high. It would be too loud. Oh, so this represents our high of the hour, right? And this currently represents our low of the hour if this is all the information you're given at 8 a.m. So now as we continue to make, we don't make a new high. And so that to us has this lower volatility box already plotted, ready to go. But now in real time, this is our low that we have. And so our upper end of the volatility box, or the cyan entry line, for example, is plotted closer up here, right? And so we're looking to fade either side. And so looking back now, as we continue to make lower lows, this volatility box shifts from up here and we start to make our way down to plot exactly where it's plotted. And so if I could, yes, I would have sold the upper volatility box, but unfortunately, this was not an actual trade setup that sets up in real time. In real time, we have our lower volatility box plotted here. The upper volatility box is plotted somewhere here, and we're looking to see which way we break, either up or down. And in this case, we ended up breaking down, and as we broke down, this box starts to shift lower, which then gives you the ability. So now let's say you had bounced, and we had bounced up a little bit faster, let's just say from here, and we had bounced right into this volatility box entry line. That then gives us the ability to go short as well because the box has now adjusted to the new price conditions, giving you the realistic real-time edges where you could then have taken this puke to continue to move down lower. Does that make sense, Joe? I'm going to assume yes. Yes. Okay, awesome. Glad to hear. All right, so now let's move on to our next example. And here we'll take a look at the latest FOMC event, right? Again, we're not picking and choosing. This is the latest FOMC event that we had in which we had a rate cut. But let's backtrack, right? Let's get back into the mindset of prior to that FOMC event. And for those of you that recall, the expectations of a rate cut were fluctuating headed into this FOMC event. I think 2 days before the event, we were almost certain, I think it was a 70+% probability that we were going to have a rate cut. Then, 24 hours before the event, that probability shifted where we, I think, had 55 or 60% assume that we would have no rate cut. Then again, the day of the actual FOMC event, so this was the morning, we that number shot back up to the 70% that it was heading into the event, right? And so all of this to say, I don't care about if we're going to have a rate cut or not, or what it means from a fundamentals perspective. To me, this is just information that signals that there's a lot of volatility surrounding this event and headed into this event. And so again, that is then a reason to continue to use our conservative models. And we did have folks who traded both the aggressive and conservative models to pick up this short as well, Joe, to your point. But we'll focus on just the conservative models for this purpose. We had our entries. Once we had the FOMC event come out, and the Q&A session started, price started to fall, right? And at this point, most people that at least we knew of were expecting this to be a meltdown trade. Webb, I see your question. I'll answer it right after I'm done. But most people are scared, right? This is a sell-off. This is the beginning of doomsday, and they're just looking to liquidate their positions, get out of all their longs. For us, we're eagerly waiting for price to fall into our volatility box entry lines. So we had plenty of opportunities in this case to get long. Our stop is outside of the volatility box where we give it 8 points of room. Your first target is the 8 points, which is hit. Once again, as we hit our first target, that's the only trade in which we have our risk on. So we move our stop up to break even or a little bit more. So let's say a tick above on the S&P, so 1250, which should cover commissions, I think, on almost any platform. And now you're really just looking to see if we can get the follow through to our second target, which is right at the target line, representing 14 points away. So at this point, if you think about it, your first trade, you risked 8 to make 8. Your second trade, you're risking 0 to try and make 14. And that's an awesome trade for us that ends up working much more often than not. And so this trade, the FOMC event, represented a positive 1100 trading just a 2 lot. Right? And that's really the power of having multiple models. It's when things like the FOMC event comes out or say a news report, you can adapt to that volatility so you're not a deer in the headlights. You know these levels ready to go and you're just looking to see if we catch. Now if price started to shoot down below, that's also information. Even though it's a stop out, it's information. And that's what we trade on, right? Information. You need to, or at least I've learned, at least with the volatility box, is to stop getting emotional with any trades. It's just another trade. I'm trading probabilities at this point. This represents, I think, a 2.53, almost a 3 standard deviation move. So this should contain price more often than not. And anytime that we don't, that's information that's again tradable. And I'll talk about that in the next example. Web, is this a one and done deal or does it reset for the next trade? It resets. So every hour, basically. So once these models come in, so if you're looking at this chart, for example, this is our next opportunity to now go short, right? And we're just trying to fade this market at, the entire day using whatever volatility box is appropriate. So in this case, we had an opportunity to go long. Now we had an opportunity to go short, and we're looking for a move in the opposite direction. The only time where it's a quote unquote one and done deal is if we break through even the conservative volatility box, which I'll show you in the next example. And that's then our sign to stop fading edges. So let's say in this case we had broken past. We're no longer then looking to try and go long because to us that tells us that, okay, the sell-off is real. And now we just want to look at opportunities to try and get short, right? And so now we have a directional bias. But until then, we're just trading this chop back and forth until it goes. And I think what most people consider a trending day is not what I consider a trending day at all. This to me still represents chop where I can fade each of these trends, get my T1, T2, try and get reversals, which you'll see a lot of times the volatility box gives you nearly a picture perfect reversal for the rest of the day. And that's really what I trade. I trade what I see, not what I think I know or anything of that sort. It's really just what's in front of me. Does that make sense, Webb? How about the right of the chart? I can show you in real time. The second trade was actually a stop out, I think, into the close, and we talk about this. And so the second trade, we lost, I think, a lot less than even our first contract made us on this chart. And so this trade, this day, the FOMC event, I'm not sure. I can pull it up in the videos at the end of the day, but we can show you what the end P&L was, where essentially what you got here is we had our first flush down to try and catch this move using our aggressive models. We then switched on over once the Q&A came around, and we have very clear rule sets for this. We then hit T1, T2. So just to take you through the actual day, so this trade gives you a T1 and a T2 flush. So you've hit 2 targets. Then your second trade gives you an opportunity to go long. You've hit 2 targets. And this third trade was a loser in which both of your contracts are stopped at a break even. And so you end the day up really, really nicely. But yes, this is a trade that was stopped out, to your point, just. All right, let's move forward. Now, I know a lot of folks also love to trade the crude oil report, right? And we, over the course of just all of our observations of this model, and this is what we've built this community for, right? And I'll be the first to say this crude oil observation was not by us, but in fact by our community. One of our traders in our community, his name is Dan, he noticed this, and this is where like it just became a rule, right? That's the whole purpose of the volatility box. It gives you observations. You start to make these observations. We had one in just yesterday's video that then gives you the ability to trade. But let's take a look at the crude oil report. So, just I can also show you this chart in real time if we have some time at the end, just the real charts in my platform. But by 4 a.m., we knew to expect that this crude oil report was going to be more volatile. And the way we knew that is we had broken past the aggressive volatility box models in the 4 to 5 a.m. hour, right? And this is in rules where we look at the hours leading up to crude oil because we've noticed that if price in the quote unquote overnight activity starts to be a little bit more volatile, that's then our signal, which gives us a precursor of what to expect for the rest of the day and to be a little bit more cautious when approaching the crude oil inventories report. And so in this case, we had that signal. That was our sign to continue to use the conservative volatility box for the rest of the day. Now, the crude oil report comes out, and we have our reaction. And this is on September 18th. And we did have a crude oil report on the 25th. The reason I went back to the 18th is because 25th gave us no trades. And so this is the first crude oil report that actually gave us a trade opportunity, which is why it's here, but it's not selectively chosen, right? On this crude oil report, we're now waiting patiently. Either we get an opportunity to fade the edge where we go short, but in this case, we had an opportunity to go long the crude oil report. So as price started to fall based on the reactions of the inventories report, that gave us our picture perfect. And you see this is almost to a tick. You had two opportunities to get in, a picture perfect opportunity to get long crude oil or QM, depending on if you trade the minis or USO, ETF options, whatever you prefer. Our stop is outside of the volatility box. We give it 30 cents of room. Our first target is the same 30 cents, right? Repetitive approach. You should be able to guess this before I even say anything now. Where would your second target be? The target line. And here the target line is 71 cents, which it's not captured in this chart, but into the close, we ended up hitting that 71 cents. And so we did, and this is the chart, September 18th. You can even take a look, go back on your real charts. But this then gave us two contracts once again. So to take you through the flow, we have our opportunity. These orders are parked. This level is here plotted starting 9 a.m. Pacific. So we have plenty of time to get in. You have the ability to go long. Once you hit our first target, we move our stop to break even. And now we're just looking to see how high is high. Can we get to the 71 cents or not? And if not, it's house money. I don't care. Right. And so this is the beauty of it. We had two contracts, both of which were winners, for a total P&L of positive 1,010 on a two lot, trading the full size contract, and half of that if that fits your risk parameters a little bit better. Now we'll go through a next example, and this is, I think, more of your tweet type of event where we had this event hit the market. It was sudden, it was unexpected, but we had news come out that China was ready to sweeten the trade war deal by buying American goods, and this was on September 10th. And this worked on the S&P, the Dow, the Russell, all of that. I'm just trying to show you a bunch of different tickers, just so if you happen to trade, say, the Nasdaq only, you know that this works on the Nasdaq as well, right? And so here we have a chart of the Nasdaq. Once again, 5-minute chart. So as this news came out at 8:50, and we see that the market really likes this news, and we start to make our move up higher. Now we're looking for an opportunity to get short. And we had some traders who traded this using the aggressive approach, and you could have also traded the conservative approach and still had this trade. But using the aggressive approach, you had an opportunity to go short the NASDAQ futures as price slammed into our volatility box entry line. Again, the level is plotted and ready to go once we had the low of the hour, which in this case was at 9 a.m. Pacific, so the beginning of the hour. We had two opportunities to get in here. Our stop, you guys should be able to guess this at this point, outside of the volatility box clouds, 20 points wide. Your first target, 20 points. Your second target is 25 points. In this case, your second target is a little bit lower. And just to explain why that is, so we continue to make a higher high even after our entry. And so as we made this higher high, our volatility box shifted. So our target lines went from essentially being right here all the way up to right here. So it adapts to whatever price conditions, whatever price actions actually like, right? And so at the end of this hour, you know where your price needs to be hit or where your second target should be left. And in this case, it was 25 points. Both of these targets were hit. You did have continued follow through if you happen to have more than two contracts. And this gave us a total gain of $900 on two contracts, right? Once again, systematic approach. You see through all of these charts, we're approaching it the same exact way. Our entries are in the same spot. Our stops are in the same spots. And our first target is always the same. And our second target is always based off of the target line. You do this over and over and over again. Okay, so now I'll take a quick breather before I talk about this chart because this is where you can use the volatility box for information. But any quick questions before we move on? No? All right, perfect. So now here we have a chart of the bonds, right? And we'll show you how instead of just fading the edges, we also talked about how the volatility box gives you some incredibly powerful information if you know what to look for, right? If you can be observant. And again, all of this detailed in nightly videos and our trade plan. So none of this is something you have to try and magically figure out. But in the bonds, we had signs early on, so in this 5 to 6 hour, that we should be switching on over to our conservative volatility box because even our aggressive volatility box could not contain price action. We had broken through, and so we always start our morning with a test in that first hour that the market opens. So for bonds, that's 5 to 6, and we try and measure the volatility that we expect in the bonds. So when we break past the aggressive volatility box, we know to expect more volatility, and typically that's our sign to switch on over to our conservative volatility box. But now, in this case, what you maybe see, maybe don't see, but we'll point out is we broke past even the conservative volatility box in that first hour of trading, right? And this is before our rules tell us to take any sort of trade. So this is free information for us at this point. Now, just using sort of logic, what that tells you is price is moving so heavily in one direction, in this case in the bearish direction, that it doesn't make sense to fade it. Buyers are not coming in and stepping in. What typically should happen with price action is not happening. And this is really your sign. It's free information that the bias is towards the short side. So we're only looking at short entries for the rest of the day. And we've detailed this in countless videos now. In fact, this was a setup in gold yesterday, which if you take a look, gold broke through, was trending, and it gave us an opportunity to get short. So at this point, the bonds cannot be contained using even the conservative volatility box, and this represents price action that's 3 standard deviation plus territory. So that's free information. And now I'm only looking to participate in the bond market in the bearish direction. And so one of the setups that we've talked about is once we have the sort of bias is now to go back to our aggressive model and start to look for short opportunities to get into the marketplace, right? And so using our aggressive volatility box, we had an opportunity, and I'm not making this up. I can even show you the charts, but our aggressive volatility box entry line was plotted right here. And that is my first opportunity. So really my first opportunity is any sort of pullback, but this is the opportunity where you have an edge to really trade and get short and buy or sell these pullbacks in the bonds. To me, this is a little bit more aggressive, and so my asset choice of this at this point is not to trade the ZB futures because that then requires me to have a stop that's outside of the volatility box, and it's really a risk that I'm not willing to take in a trade setup where I don't really know what kind of follow through I'll get. But I will play this by buying at the money TLT put options near term because this is meant to me to be an intraday trade. So I don't really care about having 30 plus days to expiration. So 7 days to expiration, and these options we picked up for $1.24 per contract. Again, detailed in our September 13th nightly video. If you'd like to go back and just see the setup in a little bit more format or detailed format, but we'll breeze through this, right? So at this point, we have an opportunity to get short on this pullback on the bonds. Now the question arises, where are your targets? Well, to me, the volatility box also gives you that. I have no idea of what the follow through is going to be. And anyone who tells you that they expect the market to do something, it's hearsay, right? No one knows what's going to happen in the very next second. And that's what I've just accepted as a fact. So to me, I'm looking at signs where price is starting to exhaust. And how do you tell where price is starting to exhaust? Well, where I normally would be looking to go long the volatility box if I hadn't already had this directional bias. So to me, that's represented whenever we slam into our volatility box entry lines. So we see the follow through we got, but our first move was where we slammed into our volatility box entry lines. And at this point, this is my first inclination where I might be expecting price to start to bounce up. This might be all that I'm going to get from this trade, right? Because at this point, I have no idea of what the follow through is going to look like. Our options, so we peel off a third of our options at this point. And I like to think of everything in terms of either halves or thirds, but that's based off of whatever increments that you decide to trade in. So our first third is taken off at the entry lines where price slams in. And this is represented by about a 33% gain. That's what we made and our subscribers made on these options. Now we're again looking to protect our contracts at break even. So to me, this is a risk-free trade now. If the bonds now started to bounce up, okay, I would have been stopped at a break even and my remaining contracts would have just been taken out. But to me, I really like to see the fall through because to me, that's where some real good money's made, especially if I'm risking $0. It's just house money. I like to see what kind of follow through that happens. But again, you need to do what fits your trading style. So then the second opportunity in which I expected price to exhaust and start to reverse is when we slammed into the volatility box once again in the 9 to 10 Pacific hour. And here we peeled off our second third of our contracts, which was at about a 65% gain. And keep in mind, this is a 65% gain on an intraday trade in options. Most people who are buyers of premium are looking to see this over several swing trade days if they get it at all. Right. And it's just awesome to me. And the fact that you can do this intraday tells me that I have no overnight risk. Any news event can come out. We can have more China news. We can have whatever we want. And that doesn't affect me because at the end of the day, I've just reset my positions and I'm ready to go, especially in this environment. And my last third of the contracts are taken off just towards the end of the day, where I saw what kind of follow through we got. In this case, we had volatility on our side, the IV component of the options. And so the last third was taken off at a 93% gain, even though price was very similar to where we ended. Right. And that is another way of how you can use the volatility box to just get information out, trade this information. And this is all true today, right? I think you will see, if we have some time, I'll show you some live charts. But this condition where we broke through the conservative volatility box was all true today. We knew that the bonds were trending higher. We knew that gold was trending higher. And we knew all four of the indices had broken the conservative volatility box. So a stop out using our fade edge trades, but more information to then participate in the bearish direction on each of those. And that's it. That's the volatility box in a nutshell. So I'll cover one last trade before I show you the stock demo. And we'll take a quick pause here for any futures questions. And then I'm really excited to show you this beta. Um, so our last trade that I'll talk about is just another observation, again, from our community of traders, in which we're looking at the gold futures, right? And the only time we're looking to trade gold is the 6 to 7 a.m. Pacific hour. So this is the first hour when the market is opening, and that's the only time that we've seen that gold gives us any sort of reliable edges that we can fade. And that's what happened here. So this is September 27th, just last week. The market opened. We had these levels plotted well ahead of time. So these levels were plotted starting 6 a.m. Pacific. Price started to fall down. As the opening bell rung, we had our opportunity to get long gold. You can see once again almost a picture perfect entry using the volatility box. And this isn't magic. This is statistics that's powering this, and the sheer fact of how many data points we look at to then tell us, okay, where is price likely to start to reverse, right? So our entry was at the volatility box entry line. Stop, once again, outside of the clouds, 5.5 points wide on the gold futures, which represents a risk of $550. You can guess what our first target is, the same 5.5 points. We get that follow through. Our stop is now moved up to break even on that second contract or any remaining contracts if you trade more than two. Second contract at the target line, you end up hitting both contracts for a total gain of 1290 on a two lot. And that's powerful. That to me is just, it's exciting. This is a trade 30 minutes into the market open, you're up 1290 on a two lot when most folks are still trying to gain their bearings, figure out which way they think the market's going to break. Their attention is focused on the indices. We have almost a secret cheat code trade in gold that works so often that it's not even funny. Right. And this is really just what we do day in and day out. We look at the same markets. Our trade plan outlines when we look at gold. Our trade plan outlines when we look at the bonds. And our trade plan outlines when we look at crude and the rest of the indices. So I'll take a little pauser there. We went through a bunch of chart examples. Hopefully that made sense. Are there any questions before we now show you how you can use this in stocks? And this is something beta that no one has seen yet. Give it a second while I just drink some tea. While you're presenting a shorted. Oh, nice, Paul. Did you end up making money? I don't have my charts up right now. At 53.75. I'll let took one lot off. Nice, nicely done. Congratulations, man. You are killing it. Okay. So let's move on because I think we don't have very many questions. So hopefully this is straightforward. And so now I want to show you something that I think is super, super exciting, and we'll make this exciting. And this is something that no one has seen yet. Yeah, I'll show you today's ES action in just a second. Let's actually, do you prefer seeing stocks first, or do you want to see the ES action in the futures first, Cobalt? I want to make sure I show you what You guys are all right. Perfect. We'll look at the ES first. All right. So if we pull up our charts, let's pull up the right charts. Actually, sorry. All right. So here we have a chart of the ES, right? And so let's approach this the way we approach all of our markets. Um, And so first off, we knew to expect the PMI reports today, right? And so these PMI reports came out, and the PMI reports told us that we had a number. I think 47.3 is a number. So manufacturing had started to slow down, and that is the first sign that the economy was starting to stagnate. And I think we most people are aware of this fact, but if we see another quarter of this, that's an officially a sign that we're entering recession, so on and so forth. So this was a big deal. This is not like most of the Trump news or just China news of people weighing considerations or something that just spikes the market up. But this is something concrete. It's not a consideration. It's a hard economic fact that tells you that, okay, the economy is slowing down just on a binary scale. It's a true yes or no, right? So our first trade in the crude oil, or sorry, in S&P was to switch on over to our conservative volatility box and to try and pick this long. So we had our opportunity to go long here. Our stop was outside of the volatility box, and we were looking for a T1, which was somewhere right here. I think it was a 7.5 or 8 point stop. We'll cover this in our nightly video, by the way, Cobalt, if you'd like to subscribe on YouTube. But our second target was at the target line. Now, what we see is this was strong economic activity, right? This is a true indication in which price was not able to bounce. This wasn't just a reaction, but this is something that was continued. And before I just continue about what we can glean from this, I'll show you the NASDAQ gave you a little bit more of a bounce um, where uh, right here, the NASDAQ gave you a little bit more of a bounce, but we didn't quite get to what would have been our target one. In fact, we fell, I think, 1 point short because my target one was right here. And that was just frustrating to see. Same thing with the Dow. The Dow is the one that took the heat the most, and you expect to see this, right? Dow is the one that's hit the most by manufacturing. So while the S&P and the Nasdaq were contained, you could tell that the Dow was far more volatile. And if you're looking for an opportunity to get short, the Dow's where you're focusing. And the Russell, same thing as the S&P, where we fell in. We had an initial reaction where we thought, okay, we might get this bounce up until we saw that this was actually a consistent move, right? And so, Cobalt, you asked about S&P. So I'll tell you exactly what this told us. So yes, we broke through our conservative volatility box. This now tells us that we're in 3 standard deviation plus territory. What should happen did not happen in the sense of we did not get this bounce up. And so we actually did end up falling down further. And this is then our sign that, okay, price is trending very heavily in one direction and it's an opportunity to get short. Again, I like to use the SPY options here, SPY, SPX, whatever you prefer, QQQs if you're trading the NASDAQ and the DIA, but something where you can really contain your risk, or even the micros are fantastic if that works with your trading account size, right? But as soon as this candle happens right here and this candle, where we break outside of these volatility box clouds, I know and I have confirmation that we're in 3 standard deviation plus territory. And now I'm looking at the money put options, closest expiration. If you're trading XPX, you could even look at the expiration where it expires the end of the day. The Qs, I think, have a little bit more spread out of an expiration, but that's all personal preference. And now my bias is short. So for the rest of the day, this is the most aggressive place where you can get in. I could then also switch on over, and this is what I had done, switch on over to the aggressive volatility box. And anytime I have an opportunity to short the aggressive volatility box, I take that opportunity because now I have my bias. We didn't get that far. So really the only opportunity was our conservative volatility box where we broke past. And we see the sort of move that happened the rest of the day, right? Price continued to fall down lower. And we knew to get bearish as of right here when our trade did not work out to give us our first target. But subsequently, we had each of these targets that, each subsequently, we had price continue to fall down lower. We had bias. I think if you actually took these options, that represents 25 to 30% gain on this first dip, a little bit more on the second dip. I'm not too sure what the options are at right now. But that then starts to tell you how today's option activity, despite getting stopped out here, still lets you participate in the market using information. You're not revenge trading. This is all just statistics, observations detailed in the trade plan, and you can start to try recoup some of your losses here or really end the day on a positive note, especially if you're trading the full-size futures contract, or sorry, not the full-size futures, the micro futures instead of the ETS. But that's all a personal preference. Does that make sense, Cobalt? Any questions? Awesome. Anytime. That's what I'm here for. All right, so back to stocks. Now I'll pull up this beta, and this isn't a URL that you'll be able to access after, so don't worry about it. But from the audience, let's show you live how this works. And this is something we just finished Sunday night. It's something that our team worked on hackathon style to try and get ready for this presentation. So I hope it works, but bear with me with any setbacks, right? So from the audience, Cobalt, Paul, just anyone who's listening, Joe, give me 5 tickers. I'll try and take one from each of you that either you're looking at for a swing trade entry, FANG. Okay, so we'll just put in Facebook. Anyone else? Apple, Netflix. Okay, Cobalt wants Netflix. We have Apple. 2 more, just to keep things exciting. And maybe let's go outside of FANG. Maybe something a little less obvious, right? FANG, everyone kind of knows and expects. All right, Nike, cool. Now, so this is something that we're working on. We're going to be polishing it, but I think it's really, really exciting. So you come in here, and this is going to be a service in which you can put in as many tickers as you'd like. Click Generate VBD. And what this does is it generates 2 files, the conservative and the daily volatility box automatically, but this time using our daily levels. BA, Josh, you could go and play with BA2. We have our tickers for right now. But this gives you 2 files. You saw how quick that was. That was less than 5 seconds, where in 5 seconds, I can take any ticker that I'm looking at, download the study files for each of these. And so these are Thinkorswim study files that I can directly import into my studies or into my platform. So I'll show you what that looks like. So if I come back into my platform and I import from my downloads folder, right, you'll see there's 2 files that I have. And so the AS represents the aggressive volatility box study, and the CS represents the conservative. So let's input both. Yes, overwrite. And then I'd also like to input conservative. Yes, overwrite. And now we'll load in both of those, right, onto our chart. And we'll start actually with the aggressive. And now let's take a look at some of these stickers that we pulled up. So we'll start with Facebook first. What you should see, fingers crossed, is voila. Sorry. We have these levels plotted, and these are for swing trading perspectives, right? So say a real use case scenario, you've run your scan, you have a list of 5 tickers, there's 10 tickers, whatever it is that you're looking at to try and get long or short for the day, and you'd like to get your ideal entry. This now uses statistics, models, and once again, we analyze a crap ton of data to tell you exactly what the volatility box ranges look like for Facebook. And so to me, I'm actually looking at the cloud for an entry. So Facebook has not sold off anywhere close to the same amount. That gives me an edge, right? We've only sold off 1.18%. But now if Facebook had sold off at 172, right around there, so the beginning of these clouds, that's then my almost picture perfect entry using statistics, using volatility, using previous volatility data to now enter into this position, whether it's stock, whether it's options. You can take off. So more times than not, we've seen this from our beta group where folks are up almost instantly on their position and they already take off their first contracts at a 20-30% gain just day one because you've able to time the place where you take this entry, right? And so Facebook did not give us that sort of sell off. Let's look at Netflix. If Netflix is sold off a little bit more, same thing. Netflix is hovering inside of these volatility box clouds, and this is still the aggressive volatility box, right? If we plotted our conservative, you'll see that we weren't even close. And that then starts to tell me when people are saying they're getting excited about, a pullback opportunity or so on and so forth, this to me represents a real pullback opportunity. It's not that it's not just, a moving average or something, it's real statistics. And so using our conservative box, we see price had a lot more to go. So we'll just remove this for the time being because I'm not too sure that anything hit the conservative today. Let's move on. So Nike, 1.72. We see Nike is far closer. This dashed line is sort of our equivalent of the cyan dashed line here. So if you were looking to aggressively participate, Paul, will this be? We're still trying to debate that right now. If it's going to be separate, if it is for users, it's going to be just a nominal fee that's added because it does cost a lot to run the data for all of the tickers. But it's something it'll be trivial, trust me, and you will like it. And we'll take care of you. But prices will increase for our tool once this is sort of ready for public. But anyway, so for the stocks of Nike, this is your most aggressive. And this is like if you are just dying to get into Nike, you're looking for any opportunity. This is the first sell off opportunity where, okay, you now have some sort of statistical edge, and this is your opportunity to get in. For me, I really, really prefer the clouds, but if I don't get it, this still gives me an opportunity. But now, if I got the clouds, I usually see a bounce back into at least this level, which is a nice 10-15% gain on the options, which already almost just pays for either these subscriptions, any of these tools that helps you get to decide any of these levels. I think one more ticker we had was Google. Same thing with Google. We didn't get quite a bit of a sell-off here. We got close. And I think Just, you talked about BA. I can rerun it if we need to for BA, but I'm imagining BA will be the same thing just because we only have a 1.18%. But hopefully what you see is how exciting and how powerful this is, where you can come in here, just you can put 50 symbols, you can put as many as you want. I don't think you should put in 50 because it will break Thinkorswim, not our site, where the stud file with 50 tickers, you can see sort of the amount of code that is generated. If I show you actually from this volatility box, the amount of code that powers this, it's a good amount of lines, right? It's about 209 lines just for the daily, and the futures one is almost, I think, 500, 600, a lot more lines. And so you can add as many symbols as you want. But my recommendation, or not recommendation, sorry, my opinion rather, is you might create something like an Excel case suite, right? Where you're trading only the tech stocks, and you want to have a volatility box daily for all the tech, maybe all the healthcare stocks, maybe high beta stocks, or maybe your favorite tickers, whatever it is. But these are ready to go. You can come in, you can generate new files anytime. Say a stock has a particularly volatile day, you can come in, you can update this. It's just powerful and it just works. And we're going to clean this up. We'll continue to make this better. We're working on trying to create a web interface version. And Paul, just so you're aware, or for existing subscribers who are listening, our goal is to eventually make this into some sort of an alert service where you might be able to put in your 5, 10, maybe even 50 tickers that you're looking at. And it's a portfolio. You know what tickers you're looking at buying either for today or on a running basis. And you'll get an alert, either a text notification or an email, anytime we have a sell-off that deems that we have a statistically relevant sell-off where you actually have an edge. Right? And that's what we try to do, is trade with an edge. Oh, hi, Andrea. Nice to see you as well. Another subscriber. All right. So back to the presentation. Before I talk about just how much all this costs, I want to share what some of our subscribers have to say. And I think Paul, Andrea, you're both in here. And if anyone wants real feedback, these are real subscribers. I can't bribe them. They'll tell you exactly how the service is, how the volatility box is, and either how much money they've made from it. But on this page, the thing that I want to focus on is not so much about how much money people have made, because I think that's really just a factor of how well do you follow the trade plan that we've set in front of you. But the thing that I hold myself prideful for our entire team is the customer service that we try and provide, right? And so just to give you sort of a quick story, there was a time when we were still early on in our subscription, and one person was having difficulties downloading and installing this indicator. And I was on my way to get a haircut. And this is a true story. I'm not even lying. Got this email on my phone, literally turned around, came back home just so that he could have his answer in less than an hour's time. So that you feel like you're heard, right? Because my goal with TOS indicators, with the volatility box, it's really to try and make each person an independent trader, where really you have the tools at your disposal, your fingertips, to start to trade. You're not relying on me, not relying on someone else calling out trades or trade alerts or anything of that sort, where, if someone's not on or someone's on vacation, you're suddenly just blind. No, we create those labels, we create these tools so that okay, the rules are binary. Either this is a trade or not, and you can get in. And our customer service, I'll answer emails as soon as they come in if I can. But that's really something that we hold ourselves prideful on, right? So I hope that you judge us not necessarily just on all the numbers that we've talked about and how much money you can make from it, but really just on the fact that I think you just get really good customer service. And this is something that's true of everyone in Mr. Top Step and all the traders that are speaking. Is it's our genuine interest to try and help everyone make money and to create a community, because like I said, some of these observations haven't even been my or my team's observations, but it's been from our subscribers who have found these, they've shared it, and collectively we've all been able to collaborate and create a community that I think is just really doing some awesome things. And so, are there plans of having a chat room? We're not sure yet on that, Paul. Chat room again starts to make people really dependent on wanting alerts and only taking trades if, say, I or we take trades. So that's something we're debating with. This is, I think, the first time that folks can even interact with us, and so we'll keep you posted on that. That's sort of a TBD. All right. So now to the offer. Those of you who have already subscribed, fantastic. For anyone who's interested, we have a special offer for this open house where you can get 15% off of just your first month using the coupon code MTS2019. This will expire at the end of the open house on October 7th. If you'd like to sign up for this special offer, you can head on over to tosindicators.com/MTS2019. As part of it, you'll also get just a 7-day trial. This is really just 1 week's worth of volatility box. Again, this is updated every Sunday. And I think Paul, Andrea, everyone will talk about why it's so important to have the latest models, the latest data. And so every Sunday, you will need to update this indicator. And so really this offer lets you try out this week sort of for free. You get to use that data. And then if you're interested, our subscription's $127 a month. The following tickers are supported, and that's S&P, Dow, Nasdaq, Russell, bonds, gold, and crude oil, along with their micro equivalents. And you can also trade the ETFs with it. The stocks are coming out soon, but that's something separate. So please don't get that confused with this. This is for futures only. And really, our goal with all of this is to help you start trading with a probabilistic mindset, right? It's using information. It's not having analysis paralysis. It's knowing how you approach the market every single day. We even in our trade plan just have a checklist of how you approach every single morning. We give you a trading plan, which is fairly robust, and we continue to update it with all of these new observations that we talk about. When you sign up, you also get sort of a user guide, so to speak, with I think about 9, 10 videos in which we talk about all sorts of things on how to set up these indicators, how to read these indicators, along with just basic things of, okay, what type of risks should you be taking for your account? How should you be trading? How to use the ETF equivalents, so on and so forth. Um, I think this is also true of, I think, almost all the Mr. Top Step presentations. Our goal is not to keep you locked in, so you can try it out for a month. If it doesn't fit your trading style, if you're not happy, whatever, you can cancel at any time. If it's within the first month, we'll even give you your money back. I'm not here to try and jip you. Again, our goal is to try and just empower traders and make you happy. As you can see from our numbers, we all make enough trading. So this isn't unlike, I think, a lot of other services. The service isn't really my sole source of income or how we survive. It's futures, and we've built this to really try and give back, to try and trade as a community, to really start to build this holistic approach in which we can all start trading with an edge at the edge. And just to give you numbers, and this is not something I like to talk about, we started this service in August 2019, and so far our users have represented about a 20% ROI for the month of August. It was beautiful. In September, we were much higher. We were close to the 20% headed into the end of the month, but we had some losses, and so that dropped down to 13% ROI. But really, what I'm hoping that you see is our goal is to continue to improve this. We take suggestions very seriously, and our goal is by the end of this to make this the best ROI trading tool in your arsenal that just gives you information and lets you start to trade like a pro with the pros. And so that's really just our presentation. I hope at least throughout this, you've learned something at the very least, and maybe been entertained. I get really interested and excited when I'm talking, so if I was a little loud or anything of that sort, I apologize. Thank you all for bearing with me, even despite my sick voice. I'll now pause. Any questions that folks have? I know, Marlon, I think we have a good amount of Q&A time, but I'll open it up to question and answers if anyone has any questions. Otherwise, thank you all for listening. I really, really appreciate you taking the time out to listen. I know your time is your most valuable commodity, and I appreciate you lending me some of that during this presentation. Thanks, Paul. I appreciate all the kind words and all of our interactions as well. Thank you. Thanks, John.